Good afternoon, everyone. Thank you for joining today's Ask Me Anything session. My name is Christina Wood, Head of Programs here at Communitech. And before we get started with today's session, I would just like to go over a few housekeeping items. So as you all know, we're here today to talk about angel investment, which is a huge topic for founders starting their journey. And we've assembled a really great panel to speak with you today. We have received a lot of questions in advance of this session, so we'll be getting through as many of those as we can today. If you do have questions that that haven't been answered, please feel free to put those in the chat, or you can put them in the Q&A for just the panelists to see, but really using chat, I think, is the best mode for today's session. And then if you have any follow-up questions, you can reach out to your Communitech FSM or our capital services team, and I'll put that email contact into the chat as well. I'm happy to continue the conversation with you if you have additional questions after today's session. Lastly, this session is being recorded, so it will be a resource for our founders to refer back to at a later date, and will be put on our website, communitech.ca. And with that, I will turn things over to Amber French, who is moderating today's session. So Amber, over to you. Thank you so much. And Amber will introduce today's panelists.
That's great. Thanks, Christina. So for those who I have not met yet, hello, my name is Amber French. I am the Director of Capital Services at Communitech. I'm also an entrepreneur and one of the co-founders of Archangel Network of Funds, which is an early stage investment fund focused on angel stage investments. I'm so excited for this panel today. Through Communitech, we work with a lot of early stage companies, and we get a lot of questions, whether you've had any kind of investment or not, or if this is going to be your first round coming up. It's a lot of tricky water to navigate. So I get a lot of questions, especially about the angel realm. So really thrilled to have our amazing panel today. I'm going to turn it over to each one of them to introduce themselves, and then we'll just get going into the questions. So Eva, I'd love if you can just speak a couple of words about yourself, please.
Of course. Thanks, Amber, for passing the mic to me. So Eva here. Founding and general partner of Two Small Fish Ventures. Before I become an investor, as a VC, I actually was an angel. And before that, I helped Alan, my husband, to build the largest consumer internet company here in Canada, Wattpad. So Wattpad has over 100 million monthly users. Last year it's being acquired by Naver, the South Korean tech giant, for over 800 million Canadian. And I'm so glad to be here and sharing my experience as an operator, entrepreneur, and also as an investor. Nice to be here. Thank you.
Thank you, Evan.
Thanks, Amber. I'm Evan Clark. I'm the Executive Director of the Golden Triangle Angel Network, GTAN, an angel investment group here in Waterloo. In our history, we've done about 170 deals, a little over 70 million into our greater ecosystem. And I'm happy to be here today, Amber. Thanks.
Awesome. And Katie.
Thank you very much for the opportunity. I'm excited about today. My name is Katie Salem. I'm the Executive Director of York Angel Investors. I started out as an angel investor within the York Angel Group, and now I'm the ED. My background is more of a generalist. I kind of grew up at Ernst & Young, doing a bit of due diligence on a ton of companies in various sectors while I was an auditor, and then as a consultant in their strategic consulting division. So that's my background, and I'm passionate about the space. Thank you.
Awesome. So I think we've got a fantastic turnout today. Thank you all for your time in coming to this hour-long panel. We've had a lot of pre-questions come in, so thank you for those. I'm going to try to save a lot of time at the end of this so we can get to even more of your questions. So just post them in the chat as they come up, and we'll get to them, make sure we leave lots of time at the end. But Evan and Katie, I think there's just a lot of confusion and mystery surrounding angel groups. Would you guys get into just, I guess, explaining a little bit about GTAN, a little bit about York Angels, who is an angel investor, and what is your, how do your groups work?
Do you want to go first, Katie, or?
Sure.
Go ahead.
So how do angel investors work? I know while we're kind of similar, there's a bit of a difference. I think, first of all, the obvious is geographically. We're kind of in northern GTA area, big span region of members. I think our membership base is quite diverse. We we all come from different backgrounds. There's generalists like myself who are professional. I have a lot of senior executives from financial services and telecom industry. I have exited entrepreneurs that are part of our group. So a huge mix, as well as a mix in obviously ethnic background. Because of the region that we're in. So that's, I think, a big differentiator, but all passionate about the ecosystem and all kind of wanting to not just write checks, but also somehow offer advice and mentorship to the startups that cross our paths.
Evan, what about GTAN?
Yeah, similar to Katie, we have a group of roughly 70 members who come from all shapes and backgrounds. They are people like at York Angels. They come from professional services. They were previous tech founders. They're people with who have done well in their careers and just want to give back. And regardless on their motivation, they all come to GTAN in order to find the future of technology and the future of founders to invest in. We typically like to see a full layering of our members. So people who are either super angels, or they've come in with a fund, so there's some structure around them, or they're just coming in new and trying to learn from some of the best. So to Katie's point, the real benefit of the angel groups is a vast diversity of people all coming together to rally behind a great idea.
You walk me through the process. So a company decides that they want to raise early stage capital. They think that angels are the right way to go. And we're going to save some time explaining about the continuum a couple of questions down the line. But a group wants, or a company wants to come forward and pitch in front of your group, your membership. What does the process look like, and what are their chances of getting in front of the group?
Yeah, so we have a variety of ways into GTAN. The best way to get into an organization is to, if you know an angel that happens to be a member, to have a conversation with them and bring you to the rest of the group. A warm referral is always an easy way in. Outside of that, we look for great referrals from outside sources such as Communitech and our greater ecosystem. Outside of that, we do have a simple application form on our website where anyone can reach out and fill it in, and we take a look at every single one of those 1,000 or more applications that come to us each year.
Yeah, on that note, exactly. So we take applications from the website and all the referrals, and the process, and maybe there's similarities as well with GTAN here, is that we do a read of the application. There's a subset of the membership that does a read of the written application, and based on that read, we decide which ones to invite to what we call a screening meeting. So think of it, we get dozens of applications every month. We select 4 for the first screening meeting and 4 for the second screening meeting, and that's where the entrepreneur gets to present 10 minutes, followed by 20 minutes. I call it a Q&A and advice. So it's not just questions, it's also, you know, our angels are great, like I'm sure GTAN's angels, they can't help themselves. They're like, you know what, I'm going to connect you with so-and-so, or have you heard of so-and-so, or maybe you should talk to this person. So it's that 20-minute Q&A and advice session. And based on the evaluation of those, let's say 6 to 8 companies in the screenings that we do, the 2 screenings a month, we select 3 or 4 companies to present in front of our entire membership at the month-end investment meeting. And that's the process. And then if members are interested after the investment meeting, where we ask for a show of hands of who wants to dive deeper, do a due diligence call and ask more questions and really get into the nitty-gritty of the business plan, the financials, the IP, etc., we schedule a due diligence call. And that's kind of in a nutshell the process of working through our funnel. And it's on a rolling basis from our point of view.
Perfect. And so they're starting with the application or the warm introduction. They're going up in front of a pre-selection committee to get in front of the actual member group who meet on a monthly basis. And then from there, if there's interest, they're getting further into diligence sessions. What does that timeline typically look like for an average company who's putting in right from kind of submission right through to funding? Like what can a company expect?
So it could be, if you're like really good in the timeline, like somehow you managed, it could be as little as like a month, right? If you come to York Angels and you apply and you have a data room ready and your presentation's ready, so that, after the investment meeting, if people put up their hands, your data room is already in DLM, the software that we use, then we can schedule a call right after the investment meeting, and and you have a term sheet, for example. There's no back and forth negotiating. It could be a 1 month cycle, but it also can go up to 3 months, depending again on the preparedness and whether there's negotiation to be had for the investment terms.
And Evan, you mentioned too, you were starting with seeing about 1,000 companies getting applications in per year. What is that? That's top of funnel. What does it look like going through down to the bottom of the funnel? How many companies typically get funded?
Yeah, similar to at GTAN, we see 30 companies present at our monthly investment meeting. So three a month over a course of 10 months. So it's a 30 to 1,000 ratio. And we also have another track, which is a fast track program. So companies that are coming with strong references and deals in hand, those we see roughly 12 or so of those a year as well. So in total, 42 to 45 companies get in front of our group with serious investment asks. Of those, last year we did 26 of those deals. So we do have a fairly high hit rate. And in terms of timing, to Katie's point, the founders that come that are most prepared and have a polished story, and potentially even some investors already in on their cap table, make it go quicker. And they can go from 4 to 6 weeks, which is fairly standard and fairly good. And some of our fast track companies go from pitch to money in the bank within 6 days, as we've seen.
Yeah, so the process can vary quite a bit, but for a founder who's kind of coming through first time, maybe didn't get that warm intro, it's probably they should be looking at least a 3-month long window from when they're putting in the application to when they potentially could get funded by an angel group. So it's just something that comes up very often. So trying to manage those expectations for everybody who's never been through this process before.
I bet that for most founders, it's a 6 to a year-long cycle to find funding from wherever you're looking for, and the angel groups would be similar.
Yeah, absolutely. And one of the other kind of misnomers about angel groups, or some of the common misunderstanding, is that for the most part, angel groups, it is not a fund. So if you have 10 members who are interested from an angel group, those individuals are writing individual checks into your company. It's for the most part not a fund. There are a few exceptions to that rule. But we're getting into the fund topic. So Eva, can you tell me about Two Small Fish, when you started, what kinds of companies you look for? And then we're really going to get into the continuum of what this looks like. So
thank you so much, Amber. So, as I mentioned in my introduction, I started off as an entrepreneur, operator, and built something massive. So when I started Two Small Fish Ventures, as an angel vehicle, I kind of put myself out there as a not a group, but myself. Some people classify that as a super angel, because not only do I provide capital, but I also experience in building something massive. So, in that structure, we bring in, different kind of like value into the ecosystem, but most importantly, it's the operating experience. And there are many super angels actually in the ecosystem, but they tend to be very difficult to find. And you really need to have that kind of a warm intro to get connected. A lot of these super angels, they probably have built something massive themselves, or they're early employees, of these very successful companies. Some of them have exits, some of them are still kind of like, hustling in those. But nonetheless, we, as a special group of angels, basically come in more as, bringing in our experience into the ecosystem. And, eventually for myself, I transitioned myself as an angel and become a VC fund. I raised a small venture capital here in Canada, and I invest, I would say North American wise. So what's the question again? It seems like I'm kind of like rambling and lost track of it.
No. So just wanted to learn a little bit more about Two Small Fish. And then I think what we can probably do is get into just some of the the different expectations that might be involved in when looking at companies through angel group lens versus through a VC lens. So one of our pre-questions was like, how early is too early? For an angel group, maybe we'll go Eva first, and then we'll talk to Evan and Katie. But Eva, what stage are you typically looking at as far as traction goes? And then we can get through some of the other metrics as well.
So I think, there's one principle You know, when you're going out for fundraising, you're basically asking people to marry you for the next 10 years. And, you know, the whole idea is like, I have put skin in the game. I'm putting my blood, sweat, tears, everything, you know, into this venture. Come join me because we're going to be able to make something very, very successful. So what was too early? When you have no skin in the game. Meaning that, you know, you basically have an idea. Oh yeah, let me just raise some funding, see if anybody will fund me. Well, you know what, that's way too early. So, you know, for those kind of, you know, a situation, the best group of people you should talk to are friends and family. So for me as a VC fund, because I'm not only investing my own money, I'm actually managing other people's money. So how VC fund works is like, you know, as a GP, you know, we put in our own money and we go fundraising, just like any founders of startups. So, you know, fundraising for startups, you know, you probably need one lead investors and then a few others, and you fill the round. But for us, we may actually have to talk to, you know, a few hundred people, a few hundred funds of funds, and then, you know, end up have, you know, 10, 20 of them. So we are actually fund managers. So we actually have different mandate and governance. So for us, you know, we cannot just say, oh, you know, we're good friends with Evan. You know what? Evan is an awesome person, so let me put money in his startup. If it is not actually within our thesis and it's not, you know, within the scope of it, maybe too early or maybe sometimes too late, you know, hey, he raised Series B, and then you come to me and say, hey, Eva, you want to come in? The answer is, even though it's a very attractive opportunity, sometimes when it's outside of the scope, we cannot really do it. So I think, you know, that's the difference between a fund and angels, because angels, you know, they have more flexibilities. They have less people to answer to. Like even for angel groups, you know, 10 angels, they come in, they all come in individually and they answer to themselves. So when you go to a VC fund, the fund manager is basically representing, you know, a group of investors, or what we call limited partners, LPs, behind us to manage their money. So we have, you know, stronger governance and mandates.
Yeah, absolutely. And then so Evan and Katie, just as far as traction goes, who are the successful companies who are getting through that pre-selection process? Like what bare minimum traction are you typically seeing angels writing checks into?
Yeah, we have angels that invest both early and later. So it really depends. And to Eva's point, with our angel group, it's very diverse in terms of the types of companies we invest into. So what is early traction in a health tech company versus an enterprise SaaS is very different. So there is some nuance to it in order to find success in getting investment. The challenge often isn't necessarily just how great the company is, but how great your competition is for raising capital. So if you're an enterprise SaaS company and you're doing well, there just might be another one that's growing 10% faster, or there could be a health tech company with some really great IP. So it's not necessarily just tell me the line that you must cross, and there's a hurdle, and then you'll attain investment. It really comes down to a lot of factors, especially the liquidity of capital at the time and alignment with individual angels.
Yeah, I have to say, just even based on the questions, it's not like a clear-cut binary decision-making process at the angel stage. We could say that, yes, most of my angels, if I look at their profiles, prefer product market fit stage, but have we invested in early stage health tech companies where it hasn't even been FDA approval? So we're talking pre-revenue, but they're obviously scoring high, if I may use that language, in some other criteria, for example, the team, the technology, the competitive edge of the technology, right? Versus something, another type of a business and sector where, you know, we are looking for sales, we're looking at ARR, we're asking what the churn is, and so on. So unfortunately, it does depend on the sector and the market. And having said that, some of the questions they're asking is, we're sector agnostic, and I'm pretty sure Evan is the same. Yeah.
Are there any hot industries that have been trending this year? I'm going to go off.
I've seen a lot of health tech, to be honest with you, at York Angels. A lot of health sciences, whether it's digital, medical devices.
Whatever happened 5 years ago in the health tech space, they're all coming to a head now, looking for great funding. So we're the same. A lot of health tech, a lot of companies with some sort of IP and a clear, advanced.
Yeah, on my end, I'm seeing a lot of Web3 type of opportunities, also in fintech, and a lot of technology, from a not necessarily decentralized, but fractional home ownership or fractional, this and that, and it's quite interesting. But I think basically the pandemic has opened up a lot of opportunities because people's behavior in some ways changed. And, even from prop tech perspective, all the way to, marketing tools, last mile delivery. But you know what, I want to kind of take this as a, opportunity to quickly, answer some of the questions that's on the chat, when it comes to, how early is too early, where do you get money, pre-revenue. I think I want to sum it up in one way, one framework. When you basically go fundraising, you need to know who you are talking to and why they come into the market to invest. Some people are, super angels. They may write, $25,000 check just to be helpful to the founders. And they really, have very little governance, but, for themselves because they're angels and they only want to kind of like, help and be helpful, to the journey. But there are actually some very early stage funds, take the model of what I call index the market. They actually invest, just look at Y Combinator. They put in, I don't know how, the money that they put in, like how many companies they put in, like 500 startups, they talk about 500. So every cohort, they fund, 500 companies. Every single investor, whether they're VC, whether they're, accelerator or angels, they all have their own, what I call fund mechanism or investment mechanism. They want to create a cohort of, how many companies, how early. So there's no one size fits all of like, what's your traction before you go, because some companies, some funds, they actually go pre-revenue. I can go pre-revenue, but that doesn't mean that you come to me with just an idea. Like Wattpad, the company that, I helped build was, with very minuscule revenue when they raised a seed fund. The seed round versus B2B SaaS company, they may already have monthly recurring revenue. So there's no one size fits all, but most importantly is to what you're targeting, who you're targeting to when you are pitching, and know exactly what is that return model looks like for them, to prepare your pitch.
Yeah, I think you brought up a lot of great points, and I'm going to dig into just a couple of them too. So in the absence of revenue, then, what are ways that companies can demonstrate traction to early stage investors?
So for me, as a VC, and I focus on building on investing company that can actually become something very massive. As I said, because of my experience in building Wattpad, I have all the intention to help build massive companies here, primarily in Canada, but at the same time, I would say more in North America. So for a lot of the times, I go into the pre-seed stage, meaning that they probably have a few, angels, funding them. Maybe angels, it's not the right word. Maybe it's their own sweat equity. They may be part-time building the product, and finally they have some meaningful traction, and now they want to go external funding. So what does meaningful traction means? Meaningful traction in my books as an early stage VC investing in pre-seed deal, as small amount as $100,000, it means that you have enough data or signal that you have at least got technology market fit. Meaning that whatever you're building, there are signal either from the users, if it is a consumer product, or companies or pilots, that actually say what you have right now really seems to be solving a problem that it's a hard problem to solve. And people seems to be showing interest that they want to continue to engage with that technology or platform. Then that's when I kind of like, okay, so let's take a look and see if this is something that can become something very massive, from a technology market fit into a product market fit to a company market fit into, an industry or a segment leader. So that's the type of lens that I will go through when I'm looking at opportunities.
Evan and Katie, do you find the same things with angel groups too, or are there other areas of traction that angels are looking for?
Yeah, absolutely. I think we have a deal in common that we both had a lot of participation in recently that was definitely pre-revenue, but got a lot of investors excited. And I know some of my investors, their initial commitment was half of what they finally ended up investing in, because after the DD call, they were like, yeah, no, I'm going to double my investment amount. Again, pre-revenue biotech space. I think the founder and the advisors were a huge factor. The fact that it was an experienced founder. I think it was, I think to Eva's point, the fact that this had global potential, like massive, massive potential market size. So not like a niche area. And I think during due diligence, you get that, what we call the personal insights. I think the way a founder presents themselves, the way they answer questions, we saw a level of integrity in the founder that we certainly appreciated in the manner that the questions were answered. So those are all subliminal kind of side things that you get a feel for once you spend 2 hours, maybe once, maybe twice with a founder and your investors, and the way they address the questions, the way they address them, head on with honesty and integrity. That was a huge factor, I think, for a lot of our investors as well. But Evan, the deal I'm talking about. You can add, I think, to how that happens, right? Like, we're not going to see revenue for a while from that one, but definitely got a lot of investors. Yeah, maybe never.
And again, it depends on the market, because in this case, there's a good chance of acquisition before revenue ever occurs. So the question comes in: how defensible is the IP, and how believable is the founder? Now, to the point of like early stage signals, like I'll make an analogy. I've spent a lot of times working with bands, a lot of bands, and the earlier you go, the less of a band you have. So you'll get someone coming up and say, "Look, I want to tell you this story about this great #1 hit song I'm going to write, but all I know how to play is the drums, and so you got to listen, and you have to listen for all the things I can't play at this moment." And most people cannot hear the song you're writing. Let's be honest, they're not going to hear the song that you're trying to orchestrate when you're just playing the drums, but some can. And you have to find those ones that you can sort of see between the lines, and you can bring them along in the story just long enough so you can get them to a point where I can find somebody else who can come in on this crazy startup, another stage, achieve some sort of milestone, and take it to the next level. And that's sort of the continuum. When you look at all the investment, you have to know what your stage is currently doing, and look what the next 2 or 3 other people are investing in, and be able to line up the dots.
Eva, back
analogy.
Yeah, no, I love that analogy too. I suck at music, so I can't.
You'll be great. I'm sure you're fantastic.
Eva, you had made a point previously as well that you look for these really massive market opportunities. That is really inherent in venture capital. And so I'm just wondering if you could explain just why that is the case, the fund mechanics, the reason why the math kind of demands that, whereas an angel, it might take a little bit of a smaller market. But yeah, if you can great.
So I think, at the end of the day, I actually, also see a question here. Like, what is, angel investment, 3.0, VC 3.0. So I'll explain to you what exactly a fund mechanism is. For fund mechanism, basically, they when we raise our fund, we actually do our modeling. Let's say we want to make it simple, $10 million. How many companies are we going to be investing? What's the check size? So we actually have to model it. And typically, if we're looking at the normal curve, of investment in general, we're talking about very risky investment here. Very, very early stage. We're not talking about the public markets of buying Apple's, Tesla, and all these things, going back and forth within a 10, 20%, you kind of like, yay, like that. We are actually taking opportunities that we will never see the money back, ever, right? So let's say there's a 10 investment, typically 30% of them, once we've written the check, we'll never, ever see those money back, ever again. So that's 30% loss right there, okay? And then 30% of them, if we are lucky, we're going to get our money back. And maybe, if we're even luckier, we will be getting a 2x return. And then another 1/3 of it, then they will give us, 3 to 5x return. That's typically, what it is. But so if you can actually look at this distribution, VC, basically, it's kind of like making a little bit of money. I was actually a CVCA, over the weekend. For any VC fund, especially in Canada, the long-term 10 years return is hovering around 10 to 15%. So that's basically how VC fund works, over that period of time. Why? Because a lot of the companies actually, in our portfolio will never see the money back. However, if we can have one company that becomes something massive, that will make the fund very, very fantastic, in terms of the return. So our job as VCs is to look for these gems that have that potential. Because if we, kind of like, if we just create a mediocre company and bet on one potential, massive exit, what if that massive exit never happened? Then we'll end up having a basket of mediocre companies that, half of it will never see the money. So that's why for VCs, we tend to, look for opportunities that actually can potentially give us that kind of an exit, so that, when you average out our distribution of casualty and winners in our portfolio kind of, works out, that way. So for, obviously for some VCs, they are very, lucky and they're very good, then they may have more wins than less losses. Then what that means is then the fund will do much better. So I think, when we are talking about, Web 3.0, a lot of people have the desire to like, let's just kind of like decentralize or democratize the whole VCs world. And, let's just fund companies ourselves and not go with the VCs. I think at the end of the day, whether the mechanism is angel groups or the token drops in a DAO these days, or, or VC funds, any investor should always take a basket approach. You cannot put all the money on Terra and then on the Luna token, can you?
You could.
You should not. You should not. Right. So, if you put as an asset allocation, you should not put everything in crypto and nothing in, some of the public markets. So whatever it means, when we're talking about investment, it's always a basket approach. And it depending on the fund manager, sometimes an angel is like, what are their basket, approach look like? Do they put a lot of money in the risk basket? And if that's the case, maybe they will have 20 companies 1 year because they're trying to index it. Or, some of them are very picky and they would do, small numbers, but then that will be just a very small asset allocation of their overall wealth. So that's, I hope that the entrepreneurs will get that, fund mechanism, understood here.
Yeah, I think that was very well explained. So thank you for getting into that. So Evan and Katie, what are you guys seeing as far as market size goes? Like how big of a role does that play in your selection process versus some of the other pieces that you look at?
It's again, with an angel group approach, it's complex. And I don't like always being the person that says like it depends, but it really does depend, right? Yes. So we have angels who are more looking at companies who satisfy their economic or their impact investment within the community. But then we have others that look for, they need to 10x their investment over the next few years. So for our members or for our angels who are looking to 10x, it has to be a massive market, right? Like they used to say you needed $1 billion market, and that's ages ago. Like people are looking at like $100 billion markets now in order to be able to grow quickly enough to hit those multiples. At the end of the day, if you're putting money in, the founder or the team has to double their value every 12 to 18 months. So you look for companies that are doubling. You have to do that at least 3 or 4 times in order to make an investment such as what Eva was talking about work, because most companies go double, zero, or zero, zero, or and so you're taking a risk. If you look again at the stats of like 1% of every seed stage company in the US gets to a unicorn status. In Canada, we're not quite as good. And when you go to pre-seed or angel and pre-seed, depending where people are investing, it's even more. So you're looking at, you have to make 250 or more investments in Canada in order to pull off one major unicorn. And though those odds sound soul crushing, it's exciting to play the game, and it's why angels get involved, because they want to make a difference.
Yeah, for sure.
And I think just from a finance point of view, to understand where angels come from, it's a diversification of their investment portfolio. So just like Eva said, like we invest in Tesla and, you know, and Apple and TD Bank and Rogers and whatever, right, on the stock market. So because there's less kind of turbulence in the market, although lately I don't know if you'd call it less turbulence. Angels invest like anywhere from like 3 to 10% of their portfolio in these angel deals, depending on, you know, their comfort level, obviously. So sometimes it is like mad money, right? Like you're just throwing darts and hoping. And to get to those darts, think about it. I think NACO just released a report where they said out of every 100 applications, 20% get in front of investors and 7% go into due diligence and only 6% get funded. And so when we're talking about like 9 out of 10 may die, or like Eva's 3 out of 10 are dead and 3 maybe will never see money, that's of the like 6% that actually made it to get a check from an angel investor. So it is a very, very risky, investment area. But having said that, it's a diversification tool for angels, who are comfortable with it.
So you know what, I want to kind of put more color on what Katie is saying, you know, so that you can understand, you know, from a VC lens, you know, what does that look like? For me, a team of 4, we are looking at around 600 to 700 companies per year. And out of that, we are investing in maybe 8 companies at most. So let's just say 10% of it, you know, that we see roughly that get funded. So, you know, over 3 years of time, we will roughly have about 30 companies, or less than that, 20, you know, around 20 companies. 20 companies, 2 of them will ever kind of like become the massive success. That's the statistic. Then you can see the 2 out of 200. So it's really like 1% of all the deals that we've looked through will ever, you know, potentially get to that stage. So one question here is that why, you know, we're pushing the founders so much of this massive layoff? I think the massive layoff recently, it has nothing to do with pushing the numbers. It's because the market condition is actually very, turbulent right now, that we encourage every single founder that instead of doubling, the numbers, every 12 months, and then they can raise a round in 12 months time. Think about that. Yes, while you may doubling the number in 12 months, but you won't be able to raise until 24 months later. So if that's the case, you may continue to be extremely stellar in your numbers, but the market condition won't allow you to actually get fundraised. So if that's the case, you have to stretch your pocket as much as you can.
Yeah, I think that seems to be kind of the sentiment across the board right now, is just really focusing on conservatism at this point, more even over growth to some degree in responsible ways. Obviously, so you still need to see that growth going through, but just really keeping that bottom line as lean as you can. Seems to be what a lot of the VCs are pushing out a lot of their messaging to their investee companies. So valuations, there have been a lot of questions for both pre and in this chat about what valuations are happening. Maybe just really quickly, what type of valuation ranges are you seeing in your companies that are applying through? So it can be like 5-second answer, but what typical valuation ranges? Evan, maybe you can go first. And
most of our companies that make it to in front of our members are in that $10 to $14 million valuation range. That is an almost doubling of what it was 2 years ago. So the market was fairly hot in the past year. I'm seeing some of that taper off already. So by like a couple million lower than what they were 6 months ago. But that said, they can range. We also invest in companies that are as little as 4 million in valuation, looking for their initial great angel.
What about you, Katie?
Same. Yeah. On the low end, we invested last fall in a $3 million company, and we're seeing some up to $20 million right now, some valuations in the $20 million range.
Eva, what about you with the fund?
For me, I see a lot of things. So, from early stage one, we have seen a company as low as, 3 to 5 million, whether we participate or not, that's a different question. And then we have seen also companies, in raising a big seed round, like $8 million on 40. We have seen those as well. But I think realistically, the market is going to be, basically looking at companies for a pre-seed to seed stage company, I would say roughly around, 7 million to, I would say maybe just above 20. That's probably a zone that, VCs will participate in.
Yeah, and that it typically will be lower now for angels. So angels a little bit shorter than that.
The average with NACO was about 5 million, I think, the last report that they issued.
And so when you're talking about valuations, and we'll get into kind of current market conditions now, but what kind of equity stake is a company looking at giving up, typically in a first angel round versus a first VC round? Maybe we'll go Eva first.
You know what? This is a quick question because about valuation. Someone just say, how do you, put multiple on a company? Well, you know what? If you're losing money, maybe you should give me money to put money in you. If that's a multiple approach, right? Like, so obviously that doesn't make sense. So, for me, I just want to kind of like how VC work is, they look at how much money you need. And then, let's say, you calculated it in the next 12 months, you need $1 million. Then usually you'll have to go, it's VC who priced the round, then they'll price it, based on, percentage they want. They say, okay, you raise 1 million. We usually kind of like put in $500,000 check, and that's, 5% that we want. So post money will probably be in 10 million. That's kind of like give or take, if I got the numbers right, that's how kind of like back end of the envelope of how they want to kind of like, I should say no, 10%. Yeah, if they want 10%, then it's $5 million in terms of valuation, right? So that's how they kind of like reverse the thinking rather than how much your company actually worth. It's how much they want to take as ownership and work that backwards.
Yeah, I've seen like 20% that the raise is for 20% of the equity.
Evan?
Yeah, 5 to 20. Yeah, 5 to 20. And that's a big spread. And I know that there's a lot of questions on like multiples and valuations and whatnot. I'd encourage founders not to get too caught up on valuation. To Eva's point, it's about the dollars that you need to get to where you're going at the next stage. And the markets will dictate what that valuation will look like. There's different approaches. Like some founders will come in trying to protect their valuation. Like maybe if I raise a little bit less dollars, I can protect my valuation more and sell only a smaller piece of my company. That's great, but now you have less dollars to actually grow. So if you're a founder who really wants to build something of tremendous value, the goal is to find a huge amount of capital and burn it to become something stellar and make a lot of others very happy in the process.
And if it's not cast in stone, a lot of times our angels are asking, are you raising enough to meet those milestones? Like, is there a correlation between the amount you're raising and what you hope to accomplish in the next year or so? And sometimes there's a mismatch, right? Like not thinking through that you're raising enough money to get you to another significant milestone. So you need to work backwards as well, because you don't want to be out fundraising in 4 months or 6 months, right? And because that takes away from managing the business.
So a couple of questions on safes, which is a very contentious topic in the angel world. So I know the 4 of us had a chat about this before. So actually, Eva, why don't you go first? You can tell us your opinion on safes, and then we can get into what the angel community at large thinks about safes.
I personally do not have any problem with safe notes because I think, it saves a lot of money from a founder perspective. Doesn't have to go through a lot of legal costs. And it's actually very effective in terms of specifically doing rolling close. So let's say if you want to kind of like raise a $1 million, you can have the investor to come in already and, and deploy the fund, and then you can just leave it open. And, typically there are a lot of accelerator that use safe already as well, like Y Combinator. They even have like a standard, template, for that. But I know that, some people do not like safe. I think the biggest risk for safe is because founders, if they are not necessarily, genuine, they can never convert. So what that means is then, you took my money and never give me back the money, and you continue to use my money to build your business. So that's not then, having interest alignment. So that's the risk of sometimes, when we go into a safe note investment, we have to really do a lot of due diligence, and most importantly, build trust with the founders. Because we do actually have seen founders who raise note and never convert, and it become a horrible experience for everyone.
Yeah, and I think whoever's experienced what Eva's talking about, it's turned off some investors from safes, and we've declined deals because of the safe terms. So I mentioned earlier, I'm an accountant. I never heard of the term safe until I became an angel investor. So it's not something you study in a commerce degree.
Yeah, we're the same at our club. So a safe can be a dirty word, but it's not necessarily when you start looking into it. When some of our members are fine with safes, if there's conviction around raising another round, and some safes when you start digging into it are actually priced rounds. They have once you start putting caps and discounts and everything on it, it's a safe that is a convertible note. So whatever you call the mechanism, let's just say it. We need some sort of mechanism and to get dollars into a company and to get dollars out. So whether that's a side letter to go with a safe or some sort of warrant. So there's just an infinite amount of ways to structure a deal. In the Canadian scene at the angel, if you're going to angel groups, a safe will not. Well, and I don't mean to speak for you, Katie, but at least with most other groups, a safe will be looked at negatively initially, and you have to do a lot more work in order to get it across the line.
Yeah.
So I do recommend for folks to say, well, like, is it a convertible note? Think about the options and if it's setting you up for success.
Yeah, and like I said, it's not binary because we've invested in safes because there's been so many other like pluses in the deal, right? So, but if a deal is in the gray zone, then the safe may just like tip it into the no zone, right?
Yeah, and maybe we can get back to that whole idea about it being a continuum, and it is like really everybody is at the early stage investment playing on the same team. Katie, to use some of your words earlier, but so maybe talk a little bit about the dynamics of angels bringing deal flow to VCs, like Eva, you sharing it with angel groups, and just how that all kind of works and how it can act in favor of you if you have obviously a couple of checks in the round already.
Yeah, so basically, at the end of the day, investors just want to see return. Investors want to see that the companies that they invested in have an awesome outcome. So, what it means is that, to bring in the right people at the right time, it's what we do, as, the fiduciar's duty. So, if companies that we've looked at that are like very interesting, but it's really too early for us, and we'll be happy to pass it on to the angel groups, right? And we'll say, hey, look, Evan, hey, Katie, we have something very interesting. You guys will like it. And at the end of the day, then we see them as partners, right? And at the same time, when Evan and Katie have something in their portfolio that are kind of like, what, it's really growing up. It's no longer a baby. And they are really ready for the VC world to kind of like bring it to the next level. Then they will throw it to us as well. So at the end of the day, we are a community. Like a lot of people say, when you raise a child, it takes a, kind of like a village. I would say when you actually, build a startup, it takes the whole ecosystem, including those ones that have failed before, because those ones are actually going to be the one who's going to tell you what mistake they have made and why, and how to avoid it. And those experiences also very important in our ecosystem.
Yeah.
It's
like a baton, passing.
Yeah.
To build, yeah, I agree with you. It's Eva. It definitely takes a village. We always say it takes a village in a vineyard to raise a startup. But to put another spin on it in the same way. So all the groups and everybody tends to share deals going forward and backwards. So if you think about who you want on your cap table later. So if you want Eva, or if you want like some of the other groups like Golden Ventures or Union Square, or if you want some of these types of players on your cap table, then when they get the deal, it has to look a certain way. So when you're looking at today's round, if you're trying to maneuver a safe into some kind of instrument today that's going to look quirky when it gets to the next group of people, that can kill your deal. That can kill your company as well. So just be mindful of take a later lens approach and work it backwards to make sure that you're setting yourself up for success. And if the angels or if the groups that are trying to pressure you into do things that don't make sense for your later looking company, have a conversation about it and try and negotiate around it.
Yeah, I think that's an awesome piece of advice. I have a question from Lauren. So who decides on the investment vehicle?
Usually it's the lead investor. And if it is a party round, then, you know, whoever, you know, around the table make the most demand will probably, you know, go the way. So we have to understand that when we are fundraising, unless you are like the darling in the ecosystem that everybody kowtow to you, you know, you have all the power. Usually it's the reverse, meaning that you're on your knees, you go, please, Evan, please give me a term sheet. And if he throw you something, you have no other choices, then you're going to take it, right? So it's unfortunate that it's kind of like a matching game. You know, you try to go after the prettiest girl in a party, and she ignores you, then you know what? Go to the second prettiest girls, you know, and then or kind of like be the wallflower. Maybe you got someone to come and say, hey, you want to dance? You know, it's just human dynamics. So I hope that makes sense to everyone.
Yeah, absolutely. I might try to go through, just do some rapid fire questions. I've been taking some notes as we go along. So one from David, what are your thoughts on Canadian startups that stay here versus move to the US? Personally, I've seen more success raising from US angels VCs and met more Canadian founders that exited after moving south. Does anybody have thoughts on that?
Well, we built a largest consumer internet company and sold it, you know, for over 800, all based in Toronto. Yep. There's no need to go there if you don't need to. I actually don't think we need to, because we have an ecosystem that is actually more superior, in my opinion, you know, than the Valley, except that we don't have enough capital as in the States, and we, you know, investors tend to be a little bit more risk averse, you know, than the States. However, if we're talking about talent, we have all the talents that we need. Canada is the most diverse, you know, country, I would say, you know, from an ethnic perspective, cultural perspective, and very gender balanced. And we are very open and friendly people. So for us to build a company that can be global, we have the DNA. So, you know, it's now a matter of you show the world that we can build something amazing here in Canada. You know, I think, you know, back in maybe 15, 16 years ago, it was expected that, you know, if you get money from Silicon Valley, the VC will say, when are you moving here? It's kind of like a given. You know, we've been asked, you know, when we were building Wattpad, it's like, okay, so now you take money from us, when are you moving? I don't think it's like this anymore. You know, we have actually more partners from the States coming to us and say, Eva, what are you seeing in an ecosystem? What's great? You know, show us your pipeline. And then they just basically co-invest with us here. You know, they don't demand anymore. So I think it's, you know, I think that nowadays, maybe, you know, honestly, maybe for Web3, a lot of people want to go to Miami because that's where the community is. That's more driven by entrepreneurs rather than the VCs. So it's a matter of you know, the type of companies or the type of talents that you want to hang out with, rather than the VCs telling you that you have to move.
Another question, it says, it seems like you need investment to get investment. Beyond friends and family round, what do you recommend for early stage or pre-revenue startups?
Definitely, definitely, like exhaust all the SHRED and non-dilutive government funding, grant, accelerators support. So we want to see that you've really done your homework and, you know, leveraged all those other sources and grown the company as much as possible before coming to angels, because like we've been saying, the theme is this is all very high risk, you know, whether at the angel or the VC stage. So the more you can do to like slightly de-risk the company, the better, is my general piece of advice. So, and I know there's a lot of platforms out there that help founders find those kind of matching and grants and accelerators to support. And I saw a question about what kind of documents you look for. So the documents we look for after, kind of, if we're doing due diligence, is like corporate structure, all the legal contracts you have, employment contracts, IP, patent filings. We're looking for, you know, management and personnel descriptions, profiles of all the, you know, from employees, founders, advisors, the board members. We're looking for a business plan. We're looking at detailed forecasts with all the assumptions, because we'll be grilling you on the assumptions, like on what basis did you come up with that, you know, factor, for example. And financial information, your capital structure, your cap table, who's on your cap table already, like how complicated is it? Are there warrants? Are there options for employees? And then we're looking at the specifics of the raise and the exit potential, which was another question that I saw. What's an exit? So So angels are doing this, unlike you see on Dragon's Den, not, for it to be a business owner. We're looking for an exit. We're looking for a liquidity event, which means that you either IPO or you sell. So for example, in the case of Wattpad, if we had been investors, that would have been an exit for us when they were bought out by another company. But that's kind of when, during due diligence, we're seriously considering the exit potential of the company by looking at any partnerships. Have you worked with anybody that's vertically or horizontally integrated with the business? Who would be interested in the company, and is that a valid potential acquirer?
And all of that, I think it's something that regional innovation centers across Canada will coach you to have a data room set up in advance of your meetings. It will help to speed things along. It's something that you can just kind of pick away at in advance of when you do need to fundraise. So the process goes a lot smoother. It looks a lot better in investors' eyes too, the more prepared you are and the more ready you are to show all of these pieces as well. So it's something I think Christina actually put in the chat. So Ashwin is Communitech's manager of capital services. So he is somebody who you can definitely hit up anytime to get some of these documents. One of these questions actually was, I think, from a potential angel investor. So maybe Evan and Katie, you can talk about how to get into angel investing very quickly and how they can reach out to you to learn more about it.
Sure. If you would like to learn more about angel investing, you can reach out to both Katie and I. We'll make sure our email is available to everyone. Every region has an angel group that is active. I recommend finding, in Waterloo's case, GTAN, or for York at York Angels, and just come see how we work, come see how our events get structured, and the type of membership that we have in our group. And we often share contacts with each other in terms of people trying to become angels, because at the end of the day, as an angel, you want to find your tribe and you want to find the group of people you want to invest with. You sort of build a circle of trust over time, and at the end of the day, if we can get more people involved in that, let's focus on the big mission.
Yeah, and I'm sure we offer obviously complimentary attendance at the meeting, because you got to try it out and see if it's for you. And Evan said, see if the chemistry's there. I know I joined York Angels because I found my people, as you call it. Same bunch of people, and no obligation. I think that's the best way to get a feel for it.
If you want to burn money, I'll find a way.
Yeah, there's lots of opportunity, right?
And in this last minute, I'm just going to take a quick minute to explain. So Communitech and a lot of other regional innovation centers, but the programs that we offer within Communitech can really help you get going. We've got a lot of great relationships with angel groups across Canada, VC firms across Canada. We host a ton of office hours. So if you're wanting to have some general conversations with angels, with venture partners, that's something we can help to connect you into. We also have a lot of resources. So things like if you need help building your data room, if you need help with pitch coaching, storytelling, things like that. We also have resources called pitch books. So it's something we can help you compile lists of investors who could be a good fit based on your stage, your industry. So there's a lot of different resources that we can offer. So I would definitely recommend becoming a Communitech member if you're not already one. It's free if you're under 20 people, your company's under 20 people. And there's a lot of great resources outside of capital as well. So I know we're very short on time now. I just wanted to say thank you so much to Eva, Evan, and Katie. Amazing chat today. I really appreciate it. And thanks to everybody who spent their last hour with us today. So I think all of us are open to being reached out to. You can go through myself or through Ashwin at Communitech. Evan and Katie are always good to answer questions, and Eva has an entire amazing team at Two Small Fish as well. So thank you again for all of your time today, and looking forward to connecting in the future.
Thanks for having us.
Thank you. Take care, everybody. Bye-bye.